Hello, everybody. Welcome to Clef Investments. Today, let's talk about portfolio margin. So, I have said many times before that if you are doing the box option spread to borrow money, you have to have portfolio margin. But I haven't really discussed what is portfolio margin. So, let's give a brief overview today. So, please note that my discussion is for US resident only, because different countries have different rules. And as far as I know, for interactive broker, the broker I'm using, they do not offer portfolio margin for Canadian resident. So if you don't live in US, please do your due diligence before you start doing portfolio margin or borrow money using the SPX Box Spread. Okay, so there are two types of margins, the regular margin account or portfolio margin, but they have the similar terminologies. So if you look at the picture on the right, your total account value is called net liquidation value or NLV. And in your margin account, you have a maintenance margin. So the meaning of maintenance margin is that if your stock drops, your NLV or net liquidation value cannot drop below the maintenance margin. So in the example shown, if you have $1.5 million of stock, your maintenance margin is 10% of it, 150K. If your stock doesn't drop more than 90%, you are safe. So how much you can drop is called excess liquidity, which is the difference between your NRV and your maintenance margin. And sometimes this is also called the margin cushion, which means how much cushion do you have if the market goes against you. But what if the NRV drops below maintenance margin? Well, that's a very bad thing. You really want to avoid it at all costs. So different brokers have different rules. For interactive brokers, the one I'm using, they have very low maintenance margin, but also they have very strict rules. Once your NLV is below the maintenance margin, they will randomly pick some of your positions and sell them so that they make up enough money and reduce your maintenance margin enough to make the account safe. So they do this because their maintenance margin requirement is already very low. If your stock portfolio drops below that, they have the risk that the money they lended to you, they cannot get it back. So they quickly, forcefully liquidate some of your positions. And the worst thing is they liquidate random position. So if this really happens, you should do it. You should pick the position you want to liquidate to make sure the maintenance margin stays below NLV. You shouldn't let RBKR do it. And the broker does that when it's close to the end of the trading day and they check your margin. So if your NRV is dangerously close to your maintenance margin, you should do action yourself. Many other brokers, they charge a much higher maintenance margin. So they have actually an internal cushion. When your NRV is less than their maintenance margin, they give you a margin call. They give you time for you to deposit more money or liquidate some positions to make sure your NRV is bigger than maintenance margin. So there's different trade-offs. Somebody like other brokers, the margin call, they have time to react. And for me, I like IBKR because it has very low maintenance margin already, and it allows me to tolerate more risk. Although personally, I don't tolerate more risk, but that gave me a bigger safety margin and actually also give me more time to react because ARV can still be above interactive brokers' maintenance margin before I have time to react. Okay, so margin account and portfolio margin account, they have different rules to define what is a maintenance margin for your stock or option position. For the margin account for stocks, they have very simple rule. It's basically 25% of your stock, no matter how low risk the stock is. So this is a maintenance margin. When you first place the order, they may ask for 50% of the initial margin, but let's ignore that for the moment. So 25% maintenance margin is a common rule for the margin account. For portfolio margin, they use a different rule. So it's a risk-based margin. Most of the cases, the risk-based margin has a smaller maintenance margin than that of the margin account. And it has other benefits that for options, it will look at the real risk of the option and only charge you the real risk. So that's a big deal for us. So for example, for margin account, the maintenance margin is 25%. But for portfolio margin, if you have a broad market index such as Nasdaq 100, they only require 10% maintenance margin. So using the example on the right, if you have $1.5 million of Nasdaq 100, such as QQQ or QQQM, your maintenance margin only needs to be 150K, which is 10% of your NRV. That means as long as Nasdaq 100 doesn't drop more than 90%, you're safe. So let's look at a few more concrete examples of maintenance margin. For the margin account, we already said that for the stock, ETF, and the mutual fund, they charge 25% of the maintenance margin. But for portfolio margin, they evaluate the risk of different stock or ETFs, and they define different maintenance margin. So for example, for S&P 500 index, they require 9% of the maintenance margin. So that means your account can drop by 91% if you have SPY or VOO. And for Nasdaq 100 index, they require 10% of the margin. But if you buy S&P 500 through a mutual fund, such as the Fidelity S&P 500 fund, FXAIX, they require 25%. So for mutual fund, they are much less flexible. So remember this. And that means if you can buy either the mutual fund or ETF, buy ETF. So VOO would be more preferred than FXAIX. But if you have a single stock, such as Apple or any other single stock, or if your account is highly concentrated on a single stock, the portfolio margin said it's too much risk, then they require 30% of the maintenance. But this is actually higher than the regular margin account. But if you have several single stock, because the risk is more diversified, then this can be reduced. But it's very hard to tell how much it is reduced. So this 30% of the maintenance margin reflects the actual risk because single stock can fluctuate up and down much bigger than any other indexes. Okay, so what about the box spread? So when we use box option spread, always use SPX. Assume the size of the box spread is 100K, which means the strike distance is 1,000. So for this kind of option spread, you can borrow almost $100K of cash. But in the margin account, you actually cannot borrow because the maintenance margin of this box spread is also 100K. So that means the money you borrowed, you cannot use it elsewhere. But for portfolio margin, the maintenance margin of a box spread is virtually zero. Last time when I calculated on a big account, it's less than 0.5%. So it's very, very small. You can ignore it. Why is that? This is because for the box option spread, no matter how the underlying stock or the SPX S&P 500 index move, whether it goes up by 20%, 100%, or goes down by 50%, 90%, the value of the box spread does not change a single dime. So it has very low risk, virtually zero risk. So that's why portfolio margin evaluate its risk and do not require maintenance margin for box option spread. So that means if you do not have portfolio margin, you cannot use box option spread to borrow money because any money you borrowed will just sit in your account and you cannot use it. Part of the maintenance margin. So that's why having portfolio margin is a must. And for portfolio margin, you have to meet its other requirements, such as you have to have more than 100K NRV, but actually you want to have a lot more than that. So we'll talk about that next time. That's all for today. Thank you.